There you go. All right, live streaming on Facebook. Okay, I think we're live and ready to rock. All right, happy Monday, Masters of the Bar Universe. My name is Amie Ward, and I am your host for Portland Cocktail Week's Masterful Management Education Series, sponsored by Kettle One Vodka and Another Round, Another Rally. This week, we are joined by Margot Bloch, a spreadsheet goddess, operations and finance guru for the hospitality world, and founder of MB Hospitality. Managing every aspect of your P&L is critical, but there are two costs in particular that make or break any bar or restaurant. Margot is here to delve into the cogs and labor to help illustrate how these impact your bottom line and various ways to manage them from both an ops and finance perspective. We have got so much to cover, but first, there are 4 things we ask our fans to do with this content. Please like us on Facebook. Please subscribe to our channel on YouTube. You will see that we are not going live on YouTube today, just Facebook, because we're having some StreamYard potential issues. So we want to make sure that we get this out to you now, but that will be uploaded to YouTube later. Please follow us on Instagram as well. And remember to comment below and ask questions. But without further ado, Margot, thank you so much for being here. Please take it away.
Thank you, Amie. Thank you, everybody, for joining us for a little financial fun on this lovely Monday. So thank you, guys. Without further ado, I'll pull up the slides, but don't hesitate, ask questions, drop things in the chat, and Amie can interrupt me as we go or save them to address them at the end. So give me a second and let me make sure I can share my screen appropriately.
So while Margot's getting all that ready, as a reminder, if you all are watching on Facebook now, just put any questions that you might have that come up in the comments, and I will be able to see them and ask them to Margot as they come along. But yeah, we got a beautiful presentation right here. Go for it.
All right. Can everybody see that okay? Awesome. All right, so I know finance is never particularly fun for most people, but honestly, the longer I've worked in hospitality, the more I really just try to break it down to the core essentials so that nobody feels intimidated by finances. Everyone feels comfortable sitting at the table, whether it's, you know, a weekly prime cost meeting or a monthly P&L meeting with managers, with owners. And so today we're really going to dive in deep to a piece of your P&L, which are prime costs. So let's keep rolling. All right, so before we go too far, what the heck are prime costs in the first place? So you may have heard this term thrown around, you may be well versed in it, but just in case, let's start off all on the same page. Prime costs are consisted of 2 primary things. So it's your cost of goods sold, or your COGS, and it's your labor and your benefits. Those combined are what we know in the industry as prime costs. What's gross profit? Because a lot of times these things are either used interchangeably, incorrectly, or one company talks about prime costs and another company talks about gross profit. So revenue minus your cost of goods sold is gross profit. So the key difference is that gross profit takes into account your cost of goods sold. Prime cost takes into account not only just your cost of goods sold, but also your labor and benefits. So what's the difference between them, and why is it a big deal for us in the hospitality industry? Gross profit is typically one of the primary metrics that you're going to see on the P&L as an indicator of health in any other industry. So if you think of a tech company that manufactures a cell phone, clearly that's a product industry, and the primary ingredient or the primary good or service that's associated with that company is the cost of goods or the raw materials associated with making that phone. If you think about a bar, you think about a restaurant, well, service is a huge component of our core business. So for us to just focus on gross profit would really neglect or just leave out a primary expense center that we need in order to function on a day-to-day business, right? You can make all the cocktails you want. If you don't have anyone to serve them to your guest, that's a problem. So because COGS and labor are two of the largest expenses that you're going to find on our restaurant P&L, we really focus on them as prime costs instead of just gross profit. And a helpful target that I always like to keep in mind when I'm working with clients and I'm first presented with their set of financials, the first thing I look at is net income, which we'll talk about in a second, or the bottom line. But almost more importantly than that, I look at their prime costs because I want to see a healthy bar or restaurant have prime costs of 60 to 70% or lower. If a restaurant or bar has prime costs above 70%, I don't have to look any further into their financials down the P&L because I know it's going to be extremely difficult for that concept to be profitable. So what do I mean by 60 to 70%? Well, if you think about every dollar that comes into your business, let's say it's on a beer, it's on a bottle of wine, it's on a meal, 60 to 70% of that dollar, or 60 to 70 cents of that dollar, is going to be set aside basically to cover the cost of ingredients and the cost of labor. So that means that 30 to 40% or 30 to 40 cents of that dollar is left over to pay for everything else and hopefully have some profit after that. So what else are we talking about in terms of a P&L, and where do prime costs fall in the P&L? So again, top line in a P&L, we always think about revenue and sales. What is the income coming into your restaurant, coming into your bar? How much are guests paying per check, and how many guests are coming in? Immediately following revenue, we hit on our COGS and our labor. That's where our prime costs are. Beyond that, though, when we have that 30 or 40 cents left over, or 30 or 40% left over of sales, don't forget, we still have to pay for operating expenses. So we have things, and operating expenses can sometimes be called controllable expenses or variable expenses because in our minds, they fluctuate or they vary based on sales. So as sales go up, maybe your utilities go up. That's an example of a variable expense. Or they're known as controllables because we really view it as, from a manager's perspective, what do you as a manager or owner have control over? Well, you can really control how many paper products you're buying, or how much toilet paper you're buying, or what's another good example? Flowers and decor. So we need to pay for operating expenses. We also need to pay for SG&A, which stands for selling, general, and administrative. Those are also known as non-controllables or fixed expenses. So unlike operating expenses, these expenses don't really vary whether or not you have a great night in sales or a really crappy night in sales. For instance, you pay a marketing firm or a PR firm a flat fee every month. Well, they don't really care if you did well in sales or not. They're still collecting that flat fee. Or we call them non-controllables because they're things that you as a manager don't really have control over. So for example, a delivery commission fee. Okay, the delivery company is going to set that commission. Yeah, you can try to negotiate, but you probably don't have a lot of control or say over what that fee is going to be. And then lastly, you have occupancy and rent. So regardless of whether or not your doors are open, in most cases, you'll have a flat monthly rent, and you might have some common area maintenance, some property taxes. In some cases, some of you will have percentage rent agreements that are based on how your sales are doing. But for all intents and purposes, it's just really important to remember that prime costs, COGS and labor, make up the two largest expense categories on your entire P&L, but they're not everything. So even though they're what your managers are probably focusing on most closely and should be, don't forget, you always need to save some cash for those other expenses, operating expenses, SG&A, and occupancy, so that hopefully when all is said and done, you have some net profit or net income left over in the field of 5 to 10% in a healthy hospitality concept. So again, just important targets to keep in mind. Cogs plus labor, 60 to 70%. Okay, that leaves you 30 to 40%. Those things get chipped away at fairly quickly. So it's really important that you feel comfortable managing to these costs on a daily, weekly basis.
For sure. And Margot, just to confirm, in that 60 to 70% range that you're talking about for prime costs, is that inclusive of, is that an average of back of house and front of house kind of operations together? Or is that, are you taking it separately? Does that change if it's one that doesn't have the other?
That's a great question. So the 60 to 70% is assuming all COGS, all cost of goods that's going into whatever product you're making. And we're going to dive into COGS in a second. And then labor is front of house and back of house labor. And it's all salaries, all management, and more than that, and we'll jump into this later too, it's payroll taxes, it's any kind of holiday PTO pay, it's workers' comp, it's health insurance, et cetera. So for sure, as you start to change your model, that number can definitely shift slightly. I've worked with some clients that are heavy on quick service, and they're able to get that number closer to a 50% prime costs.
Got it.
So you always want to kind of keep it in mind based on your concept.
Okay. And we also got, thank you for that. That was my own personal question. We did have a question that came through from the viewers right now, specifically, and this might be great because you're based on the West Coast. So the question is, how does your approach, or does the approach change when you're in a primary market where rent costs are often materially higher than where it would be in somewhere like, I'm in Baltimore, I'm a tertiary market, so things are going to be significantly less expensive over here.
Yep. So what I would say is it's always the expense as a percentage of sales. So even if your rents are significantly cheaper, let's say in Baltimore than like you said, I'm based in LA, rents are ridiculous. So you're going to be paying less in rent. And I'm quite sure you're going to be paying less in wages because our minimum wage is typically higher than yours. But it also tends to correlate with menu prices. And what I'm able to charge on my menu is also probably higher than what you're able to charge on your menu.
Got it.
So yes, the expenses, relatively speaking, are less, but I would imagine that your menu price points are also less than mine. So I do see it differ geographically, but more importantly, I probably see it differ slightly by concept type, you know, fine dining versus fast casual versus quick service.
That's a great response. Thank you. And I hope that viewer appreciates that.
Awesome. Yeah, keep them coming. Okay. So let's dig into COGS for a second, because I think some of us have kind of grown up in the industry and we're super familiar with like the brass tacks of actually how to calculate COGS. And then some of us have been given P&L responsibility and nobody ever took the time to break it down. So I'm a huge fan of kind of starting at the very fundamental level, just to make sure, okay, we're all aware of like where that number that your accountant puts in front of you in a P&L, where that comes from originally. So let's start with just a glass of wine and then build up to your entire wine program. Let's say you buy a bottle of wine at cost from your vendor for $10. It's a 750 milliliter bottle, which translates to 25.4 ounces per bottle. So I take my cost of my bottle, $10, divide it by 25.4 ounces in a bottle, and I get my per ounce cost of 39 cents per ounce. In my restaurant, let's say I have a glass pour that's 5 ounces for wine. Some of you may have a 4 ounce pour. Some of you may even go up to a 6 ounce pour. That'll always depend. So you just need to adjust accordingly. But assuming a 5-ounce glass, we'll take that 39 cents per ounce cost multiplied by 5 ounces gives me a cost per glass of wine for this type of wine of $1.97 or just shy of $2 per glass. Okay, what do I do with that? Well, going back to what we were just actually talking about in terms of menu prices fluctuating and determining my cost of goods, I really need 2 out of the 3 components listed here to determine either my menu price or my target COGS. So in the scenario on the left, let's say I have cost and menu price. So I know I have that glass of wine. I know it costs me $1.97 to serve. And let's say I've already been given the guidelines, or I've decided I want every glass of wine on my menu to be $10. I want it to be easy for the operator. I don't want them to have to think about it. So I know that $1.97 divided by $10, it's going to give me 19.7% COGS. And generally speaking, I'm pretty happy with that. Now on the flip side, let's say I don't have a set menu price. I don't know what my menu price should be for this particular glass. I do know that I want my COGS to come in for my wine program at 25%. So I can say, great, I know it costs me $1.97 per glass. I know I want my target COGS to be 25%. 197 divided by 25% gives me a menu price of $7.88. I don't like cents. It gets messy. I'm going to round up and make that a flat $8 on my menu. So those are just 2 sort of simple ways to think about menu pricing based on the information that you have and what are your guidelines. In some cases, it's going to be super important that you're hitting a target cost percentage. And in others, it's going to be super important that your menu prices fall within a certain band.
Now, would you pick that 25%? Would that be inclusive of something like sales tax? Do you do one step further to take sales tax into accountability or into account, or how do you factor that in?
Yep. So you do not need to think about sales tax when you think about costing out your wine program, because what you can think about is sales tax is something that flows in to your restaurant and then it flows directly out of your restaurant. So it doesn't actually count in accounting terms as income to your restaurant or bar. That lives on the balance sheet and it counts as basically a liability because it comes into you, but you need to turn around and pay the Board of Equalization or whatever your local organization is called for that liability. The man that goes in, it goes out. Unfortunately, none of us ever see that cash. Okay. So the only time that I like to think about sales tax, and again, that's a good question because I don't know what it is in Baltimore. In LA, it's typically around 10%. So we're higher again. The only time I like to take that into account when I'm thinking about my menu pricing is the guest does feel it when they pay their check, right? So you just want to make sure that you're aware of the total cash out of pocket that your guest is physically paying, because I do think that affects them in terms of mindset and psychology of just how they think about you as a bar or as a restaurant. But it shouldn't really factor in at all when you're thinking about your cost of goods or your margin on a particular item.
Okay.
Cool. Question. Okay. So, oops, sorry, I'm jumping. How'd I go back?
Woo.
Okay, here we go. So now we've talked about one glass of wine, or let's say just one type of wine, right? And that's all well and good, except for the fact that I think most of us have more than one type of wine on our menus. So how do these things roll up now from one glass of wine into calculating COGS to your entire wine program? So the fundamental formula that an accountant, a bookkeeper is going to use to actually generate that COGS on your P&L is actually pretty simple. It's starting inventory plus total purchases minus ending inventory. What do you have left over? So this becomes super important when you think about who's taking inventory. How are you taking inventory? When are you taking inventory? If Amy's counting it one way and I'm counting it another way, that's going to change everything. If, typically we always take it on the first of the month or the last day of the month, and now all of a sudden somebody's taking it 5 days into the month, that's totally going to affect it as well. And when you think about purchases, do I have all my invoices? Am I missing invoices? And therefore I think, oh my God, my COGS look great. I have very few purchases. And then all of a sudden, a month later, in the next accounting period, I get slammed with all these out-of-date invoices that I'm still responsible for. Mm-hmm. So it's really important that if you don't have a good system today, that you put a system in place to make sure that all of those things are as consistent as possible. Then let's talk about what this actually does with numbers. So for instance, let's say I have one type of wine. It's, let's say, a Barbera, and I have $100 of inventory to start. I buy 40 more bucks of it, and I have 80 bucks left over. Your numbers are you're probably going to have a couple more zeros on these, but I like simplicity. Mm-hmm. So your total cost of goods for that Barbera is going to be 60 bucks. Then let's say you have, let's stick with Italian, you have a Barolo. So you have 250 bucks in your starting inventory, you buy 50 bucks of Barolo, and then you're left with 190 bucks. Okay, then my total cost of goods for that Barolo is 110 bucks. But we're still just focusing on cost. We haven't taken this into context of sales at all yet. So
it's so interesting seeing that as a dollar amount until I do not contemplate, or I cannot visualize COGS until I see a percentage. So the dollar amount, I know it's so important, but I'm like,
totally.
No, percent, what is it?
but that is fundamentally the most important thing, because if you were to say to me, okay, my cost of goods is 60 bucks and my cost of goods on this wine is 110 bucks. Well, then your first reaction might be, oh, well, man, that Barolo, it's costing us so much money. It's 110 bucks. That stinks. Get it off the menu. But you can also get more sales for a Barolo.
Yeah.
So to your point, you have to take COGS in context of sales. How much are you spending on a product, but how much are you able to earn on that product? Mm-hmm. So in this case, you can see, okay, let's say we do the math. Our total sales are 180 for the Barbera. Okay, my wine COGS are 33%. I'm not totally psyched, but I'm not, afraid.
Yeah.
But then I do the Barolo, I'm making great sales off of it, and I come in at 25% on that particular wine. I'm happy. But now, how does this all roll up into your overall wine COGS for your program? Because those are just individual wines, right? So some of us might say, okay, great. Well, do we just take the average of the two? No, it's not going to be 29% because not all wines are created equal. Mm-hmm. So what we have to do is we really need to take into account how much of each wine we're selling. And so this is what's known as a blended COGS or a weighted COGS. If we're selling more Barolos at a 25% COGS, well, that's going to bring down my overall weighted COGS much more so than if I sell more Barberas at a higher COGS at 33%. So you can't just take a straight average. You have to actually combine them and get a weighted COGS. And in this case, because we sold more Barolo, my weighted COGS is not 29%, which is the straight average, it's 27.4%. I get the benefit of selling more wine at a better COGS percentage rate, right? So you always want to take that into account. So let's keep rolling for a second. I have a COGS worksheet, but I think I want to get into labor for just a minute. Any questions?
Before you jump out of the Cogs, like you picked 25% as something that you do when you're putting together this fictional or perhaps an exemplary wine program that you've done beforehand. How do you arrive at that particular number? Was 25% an arbitrary number? Does it depend on the style of restaurant, bar, their location? You know, you were talking about working with somebody in another state earlier today. So like, is it all those multitude of factors that come into it?
Totally. 100%. I would say like my back of envelope range, not knowing anything about your particular program, I want to see wine in the 25 to 30% range. And that's for the full wine program. But if you tell me I'm doing all biodynamic organic wines, I'm doing all female winemakers, I'm doing all small batches, then I start to say, okay, you're definitely on the higher side of that range, and you might even go into the low 30s. If you tell me, hey, I'm going to do all wines on tap, they're going to be from like the major national players, we get major volume breaks. Then I start to say, okay, you're definitely on the lower range of that 25 to 30%, and you could even go into the low to mid 20s. So those types of things definitely impact.
What happens when we add in, like, there are lots of different people who are watching you right now and also taking the masterful management program. How do we then factor in something when there's beer, wine, and spirits as a
great
comprehensive program?
So we're definitely going to dive into that much more in the afternoon session. But what I would always say is, yes, you want to have your overall wine COGS, you want to have your overall beer COGS, and then you want to have your overall liquor COGS. 9 times out of 10, if wine is 25 to 30%, beer might be 20 to 25%. Again, if I'm doing all craft bottles, that's very different than if I'm doing all national brands on tap.
Right.
And liquor, I actually want to be able to do, so in some cases, a 15 to 20% target. But then don't forget, if I get into craft cocktails and I get into garnishes, you need to make sure that that is all calculated in your cost of goods. And don't forget, with craft cocktails, think about the amount of time one of your servers is spending, or your bartenders, pouring a glass of wine versus making a craft cocktail.
For sure.
So COGS is only representing the ingredients, but I want lower COGS on my craft cocktails because I know it's going to take me more labor. So very good question. And then overall, all 3 of those should factor into, or should roll up into, a weighted beverage COGS. So you have an overall target, and then okay, how much liquor am I selling versus beer versus wine?
Right. Perfect. Thank you so much.
Totally.
Now to labor.
Yay! The most fun part, I'm sure, for all of us. Okay. Whoops, sorry. Okay. So let's talk about labor just for a couple of minutes, because as we all know, it's crucial to doing business. It's harder than ever these days to be able to manage it, hire for it, keep people on board. So what I like to just think about is labor includes not just your hourly wages. You have to make sure that you're also taking into account any management salaries and any other types of benefits that go along with labor. So think workers' comp, think payroll taxes, think sick time if your company offers PTO or vacation, and health insurance. All of those things go into labor, which goes into your prime costs. A thing that I like to always point out in these examples below is the difference between points and efficiencies. So for instance, we always calculate labor, again, as a percentage of sales. So if I spend, and again, I know this is simple math, but if I spend $30 on labor and I'm able to bring in $100 in sales, okay, my labor percentage is 30%. But let's say all of a sudden on that same dollar amount of sales, I'm still doing $100. I'm able to reduce my labor spend by $5. Well, now I am 5 points more efficient because for the same amount of sales, I could spend less money on labor. On the flip side of that, let's say I spend, instead of $30 of labor for $100 of sales, let's say my sales increase to $133. So I'm psyched. I can add more labor. Well, you can, but let's say I add $40 of total labor. Well, now my labor percentage is right back where it was at 30%. So I haven't been any more efficient with my labor. So the goal is always that you're not increasing your labor at the same rate. You're also able to generate more sales. We all know you have a skeleton crew. You have a baseline of labor that regardless if one guest comes in the door or 50, you need to operate your bar or restaurant. The real opportunity comes in becoming more efficient with your labor spend as those sales increase. That's where you have the opportunity to cut points or shave points. That's where things like, scheduling, phasing out, cutting people early on slower nights really comes into effect. And that's where, I always recommend to folks that they do heat maps. And a lot of POS systems today, they'll do one for you, but it doesn't have to be anything fancy. You can literally just print out a schedule. When your rush periods are, when your rush days are. Start to think about how are you going to schedule based on those peak times? When can you start to phase folks out? Who can you bring on later in the day to schedule accordingly? And then the other thing I always like to do with managers is give them a set available budget. If you know more or less what your sales are going to be, let's say it's $2,500 for the day, and you want to hit a 30% labor target. Okay, well, 2,500 times 30% means that I have $750 that I can spend for the day of labor. And then as you see sales going up, or maybe it's slower than you anticipated, then you can become even more involved with, okay, who am I bringing on? Who am I letting go? But I always try to get managers to calculate that number before the night starts, before the week starts, so that you're actually managing to something as opposed to the weekends, the month ends, you get your labor numbers and you're like, crap, we're totally over budget because I had no visibility of this number. So I know
got a
we're
really
over
interesting
time.
question. It's
Yes.
okay. I think we're getting a lot of good questions on this.
Okay.
And I got really interested in one. If a GM is a salary involved in labor, the kitchen should be costing the same way, but then it would be factored in twice with bar labor. Should you half that salary to not be redundant and double cost the same money?
So you can do it either way. You never want to double count a salary. So you can either say, I'm going to take all my salaried labor and I'm just going to divide it by 2, and front of house is going to get half of it, back of house is going to get half of it. Or you can say, my GM and my wine director are going to go on the front of house labor, and my chef and my sous are going to hit the back of house labor. Or you can also do just hourly front of house, back of house labor calculations, and then just do one salary management line item of combined management that okay, great, I'm going to have to add on 5 points, 6 points, whatever it is, to whatever your 2 hourly numbers are. So it's okay to do it either way. I always like to do it with management responsibilities and control. So that should flow with where the expense hits, but just make sure you're not double counting it and you're not omitting it altogether.
Gotcha. Whew. These are good questions. This is not something I've had to do in terms of handling both of those labor budgets.
Yeah, totally.
That's a great question. Cool.
Awesome. Any other questions?
No, those have been like the really good ones that have come through. We have asked at this point in time.
Awesome. So hopefully this was a good kind of intro to prime costs, get everybody just the baseline of how to start thinking about these numbers, how they affect your P&L. And then of course you can dive in deeper and deeper. But my recommendation would be, don't get so caught up in managing the metrics and calculating spreadsheets. Keep it simple to start and just do the basic fundamentals that you want to have visibility of on a weekly basis, so that by the time your monthly P&L comes in, you're not so beyond the month that it's too late to do anything. So I always recommend, if folks are not doing this on a daily basis, that they should definitely have a weekly report that hits on their prime costs.
Beautiful. This has been very fascinating.
Well, thank you, everybody.
Yeah, thank you so much, Margot. I've got a couple of shout outs to give here, but I loved listening to you. And I think given the questions that we got in, people really found this very, very useful.
Awesome.
Stay tuned. I know everybody's watching on Facebook right now. This will be recorded and uploaded to YouTube if that's your preference of watching it there. So let all your friends know if they're more into the YouTube world. But thank you again, Margot. Thank you, Kettle One Vodka. Thank you, Portland Cocktail Week. Another round, another rally. If you enjoyed this class, please smash that like or love button and show some love in the comments. If you want to see more masterful management classes like this one, please follow Portland Cocktail Week on Facebook or our YouTube channel. We're also at PDXCW on Instagram, so you can find out what's coming up next there. Margot, I know we didn't have the opportunity to put it on the screen for like we do with StreamYard, but if people wanted to follow up and ask you additional questions or check out your consulting company, can you verbal for us how to get in contact with you?
Totally. Come check me out. It's MB for Margot Bloch, hospitalityla.com, and that'll have my email and everything else. So feel free to reach out with any questions.
Beautiful. Thank you all so much. Again, thank you, Margot. Thank you to our audience. Thank you, Kettle One Vodka. Thank you, Portland Cocktail Week. Thank you, Another Round, Another Rally. Everybody have a wonderful Monday, and we will see you again very soon.
Yay. Thanks, everybody.